And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm Bob Pisani, joined today by Nick Colas of Datatrek, Dave Nadig of ETF.com. Let's kick things off with the markets. The Dow and the S&P 500 having their best week of the year after rebounding. And that was a miserable May for the markets we saw here. We saw some big outflows last month. ETF investors withdrawing more than $11 billion. That's according to ETF.com. The biggest outflows were in U.S. equities, but international equities also saw outflows as well. These flows are rivaling the December 2018 and January 2016 outflows that we saw. Hey, one bright spot, the bond market. Overall, U.S. fixed income ETFs saw $6.2 billion in May in inflows. Just this week, bond flows saw the biggest inflows since February 2015. It's a lot to digest. What does it all mean? That's why we're here. Let's talk about this with some of the people who are here right now, Nick Colas and Dave Nadig. Dave, 1 month does not a trend make, okay? You and I have known this. We don't make broad conclusions. But one thing is for sure, the inflows into ETFs are still positive, but they're definitely slowing down a little bit. What do we make of this?
We're probably not going to have a record year for inflows, but look, we've seen this. Flows tend to follow overall market performance. And if nothing else, you could say the last 6 months have been choppy. You know, I think people are lots of discussion about whether it's going up or down, but it's going to be choppy. Choppy tends to slow down flows, and we tend to see these moves out of things like, you know, large cap stocks in particular to this time, and into safety plays like bonds, like total market funds. Long-term buy and hold investors are going for the whole market now.
Yeah, and Nick, the ETFs are used for strategic purposes as well. So you've got hedge funds out de-risking. You've mentioned this before as a very likely reason why we saw outflows from ETFs. It doesn't mean that the average retail investor is suddenly abandoning the stock market necessarily. Am I right?
That's right. If you look at the composition of those outflows last month, it was really three funds. It was SPY, S&P 500. It was XLF, which is the financial sector, and it was EM, which is MSCI emerging markets. So that to me says it's more institutional investors perhaps using a little bit less ETF exposure causing those outflows. It wasn't just a mass redemption.
But on a broader sense, it's not surprising the industry is maturing a little bit, right? We were at 1 trillion, a few years ago. Now we're at 4 trillion. So is it a terrible surprise we're slowing down a little bit? Forget the crazy volatility and maybe hedge fund guys moving things around. The rate of inflows is going to slow naturally, right?
It absolutely will. Look, ETFs are still the preferred place for new money to go over, say, mutual funds, and has been that way for a while. But you're right, the pace of growth is slowing. Industry is getting more mature. And as Dave said, when you see some volatility, you will see some outflows now where 5 years ago you wouldn't have.
Yeah.
Right.
Bonds, though, continuing to get big inflows.
Yeah, absolutely. I think the bond market has effectively become the bond ETF market, and we've seen tons of research backing this up. Bond ETFs have become the price discovery vehicle for fixed income investors.
Yeah. And I want to go back to this maturation point about the market. Mutual funds have $19 trillion in assets under management.
Right.
The ETF business only has $4 trillion, and it's a lot lower cost that could probably satisfy the needs of a large part of that $19 trillion. Why am I wrong in thinking it should continue to siphon money off of the mutual fund business? Should it not? Am I wrong?
It absolutely will, but I don't think ETFs are going to get a strong foothold in 401k investments because of fractional shares, because dollar cost averaging when you're buying by the share like an ETF or a stock is very tough to do. So there's a natural place for both ETFs and mutual funds here, but like Nick said, new money, we're going to see it continue to go into ETFs.
And of course, remember, most people don't understand this, but when you trade ETFs, you don't normally trade the underlying shares. I don't know if you probably know the number, for example, with S&P 500 funds.
It's a very small fraction of ETF
well, you get a redemption or a
that
creation.
Actually shows up into it.
So the underlying shares don't trade, and most times when you trade an S&P 500 ETF, the underlying shares never trade.
Exactly.
Because they don't create or redeem.
Right. So when something like SPY, the largest S&P 500 fund, that could trade $100 billion on a day and maybe only see a $5 billion creation or redemption. That's a normal day for that ETF.
And this is one of the reasons, the old timers down here, they complain about the volume. So one of the reasons is you could trade these things all day long and they're not trading the underlying stocks. So what is ETF volume these days? 30% of the market?
Yeah, 25% of the market's pretty normal, and when it gets more volatile, that number goes up.
Yeah. What are you advising your clients? Like, how do you're a master of data interpretation. Datatrek is one of the best firms out there, just looking at raw data and saying, here's what it really means. Does any of this bother you in any way? What does it mean?
No, it doesn't. We actually just did this work looking at fund flows, not just ETFs, but mutual funds as well, going back for the last 3 years. And we're nowhere near a kind of devastating sell-off kind of signal. This was natural market churn, as we've discussed. December had over $100 billion of outflows from mutual funds and ETFs. That was a real bottom. 2 years ago, January, had 100 billion inflows. That was a real top. We're not at neither point.